money for bankers and no money for workers.
It was the teachers facing job cuts, but it was car workers, railway workers, health workers, even TV workers who went on strike, and the students who seized their colleges. It's been billed as Black Thursday by the organisers, and it's injected a new factor into the credit crunch. 2.5 million people on the streets in a major industrialised country.
We are here today because we are unhappy of the government because we don't have enough money. They don't increase the wages, and the problem is they told us that they will, and everybody has the same problem. We don't have enough to buy food, to buy anything important for the life.
Today, if France has sneezed, well, other parts of Europe have already caught the protest lurgy. Greece is in its 10th day of a border blockade by striking farmers, and last week Iceland's government was forced from office after Parliament was surrounded by protesters. The sudden upsurge of protest in Europe arises in the context of growing stress within the European economy, especially at its weakest points. Problem number one is the East European banking system, which is heavily exposed to bad debt and can't be bailed out, because from the Baltics to the Balkans, governments are just too weak to do it.
One of the key risks of contagion is if the market looks for what shoe has to drop next. We started with Hungary in the third quarter, had a sudden stop on their balance of payments portfolio inflows, which are equity and bond investments reversed. There was a reversal of foreign direct investment, and the currency sold off, and other currencies in the region are following suit with that. The other key region is the Baltics, which have exposure to Europe with the Nordic banks, and the market may well look there next. So at the moment, we are sort of in sort of calm in the storm.
The fear is that the fragile banks and currencies on the east edge of the Eurozone, from the Baltics to the Balkans, could drag banks in Austria, Switzerland and Italy down the financial plug hole. Austrian banks' exposure to Eastern Europe totals 70% of that country's entire GDP. Vienna has called for an EU-backed bailout of East Europe, but it'll have to join the growing queue. Problem number two is the euro. One currency, one central bank, but 16 treasuries and effectively two tiers, the solvent and the not very solvent. And the latter have just had some bad news.
Well, Standard & Poor's has downgraded Portugal, Spain, Greece, and put the rating on Ireland, the AAA rating, on a negative outlook. The main reason for this has been the external imbalances that we've seen built up in all these different countries, the lower rates of growth that we expect to see going forward, and also a significant deterioration in the public finances.
In response to these downgrades, a gap has opened up in what it costs Eurozone governments to borrow money. Taking Germany as the baseline, it costs the Greek government 2.75% more to borrow than Germany. Ireland costs 2.5% more, Portugal more than 1.5%, and Spain just above 1%. And though these figures sound small, they're normally microscopic. Investors say this is the equivalent of giving odds of 10 to 1 that the Eurozone will fall apart. At the start of this crisis, Europe, with its social model, its single currency and its cross-border banking system, was seen in some ways as protected from the worst of it. But now we know the full cost, this whole institutional framework begins to look fragile. Cue tonight another quintessential European response. In Paris, protesters took on the police and there were running battles. It's not May 68, but it is worth remembering that 68 took place at the height of an economic boom.